So right now, as of July 29, 2026, I mean, the parent company of Google is spending more money to build physical server farms than its money-printing search engine can actually generate. And at the exact same moment, 42% of 25-year-olds are living with their parents because they simply cannot afford rent.
It is the ultimate split-screen reality. On one side, you have the world's central banks locked in this grinding, frozen standoff against sticky consumer prices. Borrowing money is incredibly expensive, and it is cooling down traditional markets.
But then you look at the other side of the screen, and big tech is shoveling historic, eye-watering sums of cash into the furnace to build out the physical infrastructure for artificial intelligence. Welcome to Financial Candy. We are looking at a global economy that feels, well, completely fractured. It is like standing with one foot in a blast furnace and the other in a deep freeze.
That is a perfect way to describe it. The contrast is jarring when you look at the raw data.
Our mission for this deep dive into the source material today is to unpack how these massive abstract forces, from geopolitical oil shocks to Silicon Valley's absolute obsession with data centers, are quietly rewriting the rules for your wallet, for corporate earnings, and really for the financial reality of young adults. We are pulling from a heavy stack of late July 2026 corporate earnings reports, including Coca-Cola, Apple, and Procter& Gamble. We are also factoring in central bank data, government policy trackers, and some fascinating new demographic economic research.
The clearest way to trace this web is to just start at the very top of the economic food chain, which is the cost of borrowing money. The U.S. Federal Reserve just held interest rates steady at a range of 3.5 to 3.75%. This actually marks the fifth consecutive time they have chosen to freeze rates rather than cut them.
That decision becomes incredibly dramatic when you look at the raw inflation data. I mean, inflation actually dipped slightly to 3.5% in June, but that number remains stubbornly above the Fed's long-standing 2% target, which is creating a massive political headache. Federal Reserve Chairman Kevin Warsh, who was appointed by President Trump, is facing immense pressure from the White House to cut rates ahead of the midterm elections, which are now less than 100 days away.
And we should note, looking at official transcripts from his recent press conference, Warsh is explicitly pushing back against that pressure. He noted that he actually provoked what he called a family fight with his board of policymakers to ensure the Fed's independence.
And just to set a quick boundary for you listening, our goal here is not to take a political stance on President Trump's pressure on the Fed. We are strictly looking at how these political maneuvers are mapped out in our source data and how they impact the markets. Warsh stated very clearly that they do not possess a magic wand to instantly fix prices without causing other economic damage.
Exactly, because they are dealing with external forces. The primary culprit keeping those rates high is the global energy market. Ongoing conflict involving the U.S. and Iran has pushed Brent crude oil above $89 a barrel.
It feels a bit like trying to brake a car while someone else is stepping on the gas pedal. The Fed is pressing the brakes with high interest rates, attempting to slow down the economy, but global oil shocks are revving the inflation engine right back up.
The energy market is the ultimate smoke signal for central banks. At $89 a barrel, oil acts as a universal tax. It inherently bakes higher costs into the production and transportation of almost every physical good on Earth. Think about a standard plastic bottle of shampoo.
So petroleum is the literal chemical feedstock required to manufacture that plastic, right?
Yes, exactly. And it goes beyond just the plastic. The factory requires immense energy to run the injection molding machines. Then the diesel truck delivering that shampoo to your local grocery store costs substantially more to fill up. The central bank cannot control the geopolitical conflicts driving up the price of oil, but they are forced to deal with the economic fallout of those prices rippling through the supply chain.
So the Fed is trapped because they cannot control the price of oil. But what is truly fascinating is how that exact same $89 barrel of oil is creating bizarre winners and losers in the grocery aisle. Procter & Gamble, the massive conglomerate behind everything from Tide detergent to Gillette razors, is getting absolutely crushed by it.
They are. Their recent earnings data reveals they are facing a massive $1 billion headwind through fiscal 2027, purely due to these elevated energy and transport costs.
But meanwhile, Coca-Cola seems somehow immune. How is that possible?
The answer lies in the mechanics of retail inventory. Specifically a dynamic that P&G executives call the disconnect between sell-in and sell-out. Sell-in is the massive volume of product P&G sells in bulk to retail store chains. Sell-out is what those retailers actually sell to you at the cash register.
The numbers in the report are just completely mismatched. Consumers actually bought 2% more P&G products in the quarter, but retailers bought 1% less from P&G. If you are listening and looking at your own grocery bill, you are probably still buying Tide, but the store manager is apparently panicking.
Retailers are heavily incentivized to hoard cash right now. They see the 3.75% borrowing costs, they see the energy spikes, and they know that holding extra inventory on a shelf is effectively tying up expensive capital. So instead of ordering new pallets of detergent from P&G, retail managers are simply walking into their back rooms and drawing down the extra stock they already have on hand.
Oh, wow. So it is essentially a protective balance sheet maneuver by the stores that completely distorts P&G's overall revenue. But wait, are consumers actually economically resilient right now, or are they just highly selective? Because when you look at the beverage sector, it sounds contradictory. You would think people pinching pennies on generic paper towels would skip the soda, yet Coca-Cola just saw their global volume jump by 5%.
And outside of the pandemic recovery period, that is their biggest quarterly jump in 17 years.
Hmm.
Coca-Cola is proving that if the marketing mechanism is powerful enough, consumers will voluntarily absorb the inflation. They effectively utilized a massive global World Cup marketing campaign for Coke and Powerade to mask the pain of higher prices.
Is that basically a variation of the classic lipstick effect, where the macroeconomic picture feels heavy, so people might delay buying a car, but they cling fiercely to affordable, immediate luxuries?
That is precisely what the data suggests. We see that exact same selective resilience in the UK with the bakery chain Greggs. They just boosted profits by 20%, hitting roughly $102 million for the first half of the year. They achieved this by outsmarting shifting consumer habits.
With the
Understanding that consumer stress requires looking at who is actually bearing the brunt of this high-rate, high-cost environment. Recent demographic data from the UK, which serves as a highly accurate proxy for a broader global trend, shows that 20-somethings are facing the toughest start to adulthood in almost half a century.
The numbers here are just jarring. Wages for 25-year-olds have entirely stagnated. When adjusted for inflation, their average earnings are hovering around the equivalent of $37,500. All the wage growth progress that happened between the 1980s and the early 2000s has essentially stalled out completely.
Stagnant wages combined with elevated inflation create a severe affordability crisis, which is most visible in the housing market. Home ownership for 25-year-olds has plummeted from 43% in the mid-1980s to just 15% as of 2026. Consequently, a staggering 42% of 25-year-olds are now living with their parents.
The employment metrics are also sliding backward. For the first time since the 1980s, female employment rates for this specific age group have dropped, falling from 77% a decade ago to 71% today. I mean, it is as if previous generations got to play the economic game on normal difficulty, and Gen Z just booted up the game on survival mode with a zero inventory.
The structural consequence goes far beyond young people having less disposable cash for a Friday night out. It is the systemic breakage of a core societal expectation. For decades, the implicit economic contract was that each successive generation would naturally achieve a higher standard of living than the previous one.
When that trajectory stalls, it has to reshape long-term financial planning, right? It forces delayed family formation and permanently alters consumer confidence for decades to come, mostly because the primary mechanism for wealth building buying a starter home is effectively shut off.
Yes. So if capital is not flowing down to the wages of 25-year-olds and they are priced out of the housing market entirely, the most obvious question is where's all the money actually going? The answer points directly back to our blast furnace, Silicon Valley's artificial intelligence infrastructure.
Big tech firms, specifically Alphabet, Amazon, Meta, and Microsoft, are currently facing severe investor skepticism over their massive capital expenditures on AI data centers.
Let us define capital expenditures, or CapEx, for a moment. This is the actual cash a company spends to buy, maintain, or upgrade physical hard assets. In this case, servers, cooling systems, and land. Alphabet recently shocked Wall Street by raising its 2026 CapEx forecast to up to $205 billion.
To put that staggering figure in perspective, that single announcement caused a 7% slide in their stock and pushed the company's free cash flow into the negative for the first time in recent history. Free cash flow is simply the money a company has left over after paying its operating expenses and those massive CapEx bills. Alphabet is a legendary money printing machine, but right now they are spending more cash than they make just to build server farms.
The phrase used by one tech founder in the research is making sand think. It perfectly captures the sheer physical burden of processing silicon into advanced chips. But the mechanism of a data center goes far beyond the silicon itself.
Because these facilities require massive, continuous streams of water for cooling, plus unprecedented amounts of electricity to run. And because of this localized grid strain, municipal governments are increasingly pushing back. We are seeing actual bans and restrictions on new data center construction.
Local utilities simply cannot guarantee power for both their citizens and these new tech facilities.
Wait, are these bans just local politicians not wanting an ugly, noisy building in their town, or is it a legitimate threat to the power grid?
It is a profound threat to municipal resources. A single AI data center can consume as much electricity as a medium-sized city. The historical parallel that best explains this dynamic is the construction of the railroads in the 1800s. The railways completely transformed the global economy and benefited society immensely, but plenty of the individual investors who financed the physical tracks lost absolute fortunes in the process. The upfront capital requirements were just too high.
The critical flaw in that analogy, though, is depreciation. I mean, iron tracks, once you lay them down, last for decades. These data centers require constant, staggeringly expensive upgrades every few years to house the latest, fastest generation of processors. The tech giants are essentially building a global railroad where the iron tracks rust out and need to be entirely replaced every 36 months.
That depreciation cycle is exactly what makes the $205 billion figure so terrifying for Wall Street analysts. If the hardware is obsolete in 3 years, the return on investment has to be immediate and massive.
And while the majority of these tech giants are burning cash on an endless loop of infrastructure upgrades, one massive player is doing the exact opposite. Apple recently hit a $5 trillion market cap and is acting as a market safe haven. Their strategy is entirely divergent. They are avoiding the data center spending war altogether.
Market data shows Apple plans to spend roughly $11 billion on capital expenditures this year. Compare that to Alphabet's forecast of over $200 billion. Apple has chosen to completely opt out of the infrastructure bloodbath, deciding instead to license AI technology and cloud capacity from Google.
How does that actually work mechanically? Does Apple just send a ping to a Google server every time a user asks Siri a complicated question?
Conceptually, yes. Through an application programming interface, or API, Apple's software can route complex queries to Google's massive data centers. Google's hardware does the heavy lifting, consumes the energy, and sends the answer back to the Apple device.
So Apple basically avoids the physical cost of building the server, cooling it, and powering it. They are letting their rivals absorb the massive physical costs and local grid headaches. The shift in strategy aligns perfectly with a major leadership transition as well. Tim Cook is preparing to step down as CEO on September 1st, 2026, handing the reins over to the current hardware chief, John Ternus.
Cook's legacy seems to be maintaining this capital-light approach, preserving Apple's massive cash flow rather than throwing it into the server farm furnace.
But is Apple actually the smartest player in the room for renting the AI railroad instead of bankrupting themselves to build it? Or are they setting themselves up to be entirely at the mercy of Google a few years down the line when the infrastructure is fully established and Google simply decides to raise the rent?
That strategic gamble is playing out exactly as the regulatory environment around AI is thickening. The underlying technology is becoming deeply entangled with the U.S. government. OpenAI's Sam Altman is spending time in Washington this week, meeting with White House Chief of Staff Susie Wiles ahead of a rapidly approaching August 1st deadline for a new federal AI framework.
The lines between private tech, high finance, and the military are blurring at a rapid pace. Senator Elizabeth Warren is actively probing a new Pentagon program called the Bon-ND Initiative. And again, just as a disclaimer, we are not taking a stance on Senator Warren's politics or her investigation. We are looking strictly at the mechanics of this initiative. According to the data, the Department of Defense is attempting to recruit top-tier Wall Street talent by offering $400,000 salaries to help manage strategic capital and defense acquisitions.
The government is realizing that the AI arms race requires private market speed and highly aggressive capital allocation strategies. Traditional military procurement is far too slow for software that evolves every 6 months. By offering those Wall Street salaries, the Pentagon is trying to internalize the expertise needed to spot and acquire critical AI startups before they go public or get bought by foreign adversaries.
However, as the congressional probe highlights, pulling private investment bankers into the defense apparatus creates massive questions regarding conflicts of interest. You're essentially building a revolving door between Silicon Valley, Wall Street, and Washington.
It is a massive structural shift.
When we pull back and look at the entire landscape we have mapped out today, a very clear core pattern emerges. The global economy in mid-2026 is defined by extreme, almost violent capital allocation. On one end of the spectrum, you have 25-year-old consumers meticulously rationing their dollars between rent, stagnant wages, and the small daily luxury of an iced matcha. On the exact opposite end, a handful of mega corporations and government entities are throwing unprecedented hundreds of billions of dollars into AI infrastructure, willing to risk everything to own the future.
The tension here forces us to ask what happens when those two extremes finally collide. The sustainability of the AI boom relies on the core assumption that eventually consumers and businesses will pay a premium for the software generated by these massive data centers. But if the consumer is completely tapped out by energy inflation and high interest rates, the return on that $200 billion data center investment becomes incredibly difficult to achieve.
Which leaves us with this final thought to chew on. If Apple's capital light strategy of outsourcing their AI infrastructure proves to be the ultimate winning formula, will the other tech giants eventually lose their nerve and pull back on their massive spending? And if they do hit the brakes, what happens to the entire global supply chain, the silicon chip makers, the energy providers, the commercial real estate developers that bet its very existence on a never-ending AI boom? The economic thermometer might be completely split right now, but eventually the temperature has to equalize. We'll be here to track exactly how it plays out.